Today, folks, we're diving into more Blossom stock portfolios. Blossom, this beautiful platform that came about to help inspire investors, talk about your own portfolios and share your finances, something that I truly believe in the discourse of financial independence. I think every single person needs to become part of the investing class because we're living in a world where just a general rate of return from a job isn't necessarily enough these days to get you to your financial dreams of perhaps buying a property or traveling or just living comfortably in general. And if you're on this channel, it's likely because you're trying to do what I'm doing, which is fast tracking your financial independence to perhaps one day retire early, which can lead to some pretty spicy takes, as we've seen in the past. Cover call ETFs. We could go on about a lot of other portfolios, but I always look out for the best interest of those that really want to fast track, get their foot on the right path to actually just taking control of their financial future. So if that's something you believe in, if you're on a path to financial independence, join me, hit that subscribe button, folks, because yes, so we got two portfolios that we're going to look at today, two very prominent investors within the finance community here, especially within Canada, which I appreciate so damn greatly. And this one I thought would be super fun to kick off with because it's a portfolio that I believe is how most people should be investing. And of course, that is Brandon Beavis from Beavis Wealth, the YouTube channel. He's actually the Blossom co-founder. And I thought, hey, who more appropriate than to review from my perspective, guys, somebody that has luckily had a decade of outperformance, but this is something that I've been recommending most people do. And I noticed this was a shift years ago, I think, that Brandon made. If you've been following his channel for a while, he did have a lot of individual stocks, eventually sold them all off. And now he just seems to be an ETF investor. And I found a pretty funny clip. And we'll kind of review some of the ETFs. I mean, you guys get the S&P, but I love the core holdings that are just this. This is what investing to me is how I wish most people's portfolios looked like, because this is the quickest path of least resistance to wealth generation, in my opinion. But there's a funny little quote in here. I'll just take a listen to the intro of his recent video kind of talking about his portfolio.
In general, though, you still see the vast majority, over 90% of the portfolio is sitting in these passive ETFs, right? The passive strategy that I started doing essentially a year ago now. It probably was close to a year ago, actually. And I guess given the 1 year update, it has been absolutely perfect for my life and the amount of attention, if you will, that I care to put towards my portfolio. I did mention last time in a previous video, however, was that I did almost find them somewhat boring, almost like a little bit too passive. And I needed to start including a few of the stocks that at least allow me to have a little bit of fun and joy when I look at my portfolio.
Oh, you always love the degeneracy when it starts sinking in, eh? There's always that like angel and devil on each shoulder. And one's just like, man, just long-term cost average, keep focusing on your career, your job, build like a sustainable high income and keep getting raises and just shovel as much as you can into the portfolio and don't think about stocks. That's what he's doing here. And that's the right way to do it. But it's always funny because then on the other shoulder, the little degenerate devil comes up and says, oh God, people are bored of this. I'm a social media influencer. I only hold like 3 ETFs. I need to make more returns. And I like these stocks and I know they can do better. And it's something that I can talk about. This is how a lot of us feel, especially when you start degenning into the social media sphere. But let's just take a look at his holdings just to get an idea of the ones that are more interesting. Because yeah, I'm like more than half my portfolio is the S&P. ZEQT is a lot of questions come up about this one because people keep asking me why I chose XEQT over something like ZEQT. Now I'm going to have a hot take, a little presumption here. The reason that he went with ZEQT is that I've noticed a lot of Brandon's videos are always coincided with sponsors around BMO. So this was probably just a healthy way to reside into a global market ETF, but also, stick to his, in line with some of his sponsored content just to show him gratitude, because BMO is a great company. I wish I could get BMO to sponsor me, but nonetheless, year to date, the sucker's up 14.15%. And these are what I would call core holdings. And this is something I'm starting to do for wealth preservation. But again, if I was a newer investor, I'd be very happy putting half my money into an ETF like this that gives you 50% US, 25% Canada, and the rest of the world. This is a good foundational stock for most investors. And as somebody that is his age and very similar to my portfolio, I would focus more on growth, more US, maybe a handful of individual, but he's done a great job here. And I think he's an exemplifier for the Blossom social media sphere. And he also got a little bit of emerging market international going on with this stock, which is a very small percentage of his portfolio, which I found very interesting, which is MCHI, which is the China ETF that makes up 12%. And if he bought it anytime within the last year or two, he's done exceptionally well. The Chinese ETF is up 40%. but it seems to have some cyclical nature to it because it goes through periods of extreme rallies, but hasn't done much since its history. But regardless, I still think it's appropriate to get exposure like this, because again, there could become a time where China starts to really dominate if the US is sitting in a bubble, because China has a lot of cheap companies that are growing at reasonable rates. But we can see since inception, this is only annualized 2%, which has been god awful. But the US has been shining. People have really beaten China down. So this might be a good time to pick up a Chinese ETF to get things like Tencent and Alibaba. And I always like to point out, Alibaba does, I think, 3 or 4 times the shipment volume than Amazon does, yet is worth considerably less in market cap value. But still, nonetheless, to each their own. I also look at the emerging market ETFs, and I've been looking at them more recently because, man, the emerging markets are up 26%. And again, as you've seen, China being a huge, proponent to that. And nothing wrong. I think many major investors, the likes of Ray Dalio, are into structuring their portfolios this way. But more intriguingly, and you got to kind of clash a little bit here, because I always like to start with a conservative portfolio and then talk about one that, doesn't really fit my strategy. Doesn't mean it doesn't fit yours. But I think there's stuff we can learn from this, because we're going to talk about Canadian in a t-shirt, a massive Blossom user, 144,000 followers. I think he's got a couple 100,000 followers on YouTube. Really good exemplifier of the Canadian influencer sphere. One of the many clowns, including myself, that exist here, that I'm super grateful for. I love this space, but I also recognize that this is purely for entertainment purposes. So take whatever I say with a grain of salt, of course. But this portfolio, this one had me tripping up, because I don't actually look at many other influencers out there as much as you may think. This is something recent. I wasn't even that active on Blossom until the whole covered call explosion. And now I'm just finding it a very interesting place to more or less talk in a public Discord, because these people are comfortable enough putting it out there. I think it's good to criticize and just get some perspective for newer investors out there. And this portfolio, and I recently saw a video that he posted, and we'll start with maybe just as TFSA. It's a lot. And the reason that I think it's become a lot is he kind of reminds me of what I used to be and what most investors start out as, which is they want to control their destiny. They want to pick the individual companies. And what ends up happening is they get drawn in a dozen different directions, and they end up buying a lot of stuff that overlaps. And you end up just owning everything with the assumption of never selling it. And you end up basically building your own ETF. And when you start building your own ETF, I refuse to believe that you could manage it correctly. I just refuse to believe somebody can manage 20, 30, 40 stocks correctly. I'm somebody that believes if you're buying an individual company, you need to know it up and down, like the equivalent of working for the company. If you don't know that much about it, you're taking on a lot of risk, and you're starting to speculate and considerably gamble with your money, right? But regardless, again, look at the overlap here. I mean, we've got a ton of REITs. RioCan has a huge position here. TD, Enbridge, PLZ.UN, another REIT, Manulife, PMZ, CSH. Some of these REITs are actually pretty good. H&R's in here, TELUS, BMO, Fortis. But then when you go look at the ETFs, we've got XIC, which is a total, it just kind of represents the entire Canadian economy. You've got XCI, which is a dividend ETF. You've got VDY, another dividend ETF, that are quite different and contrasting. VRE. So now we own, the Canadian real estate ETF, while also owning a lot of Canadian real estate. And then ZAG. ZAG was a weird one to me. When I saw that, I was like, what is ZAG? I've never seen ZAG before. And that is an aggregate bond index. And, bonds have just done absolutely horrendous. I think the total rate of return on this has been something like not even 3%, not 2.79%, not all that crazy. Now, we'll look at his broader portfolio, because it does go well beyond this. And thanks to Blossom, we do have a lot more insight on his portfolio. But just speaking to the TFSA first, again, as somebody that isn't dividend oriented, and from my understanding, somebody told me he's mainly in reinvesting the dividends, I don't like the idea of this dividend snowball. And I think that's maybe what he's trying to do here. I hear that conversation a lot with dividend investors, is they get this caught up in their head of reinvesting dividends and just growing the dividend and then relying on the dividend in the future. But if you take in totality, annualized total returns, including the dividend, typically the dividend focused strategy over a 10 or 20 year period significantly underperforms a broader market or growth strategy. So if you're not utilizing the dividends, I don't typically, again, not as financial advice, but wouldn't recommend diving into a portfolio style like this, depending on your time horizon. This is more of almost what I would call a retirement portfolio. But again, even in retirement, I wouldn't want this many stocks, especially this many overlapping stocks, let alone this much exposure to Canadian real estate. I'm presuming he has this much real estate exposure because he's thinking to himself he doesn't actually own a physical piece of real estate. Because I'm one of those people that also believes, hey, if you own a piece of Canadian real estate and it's a huge chunk of your portfolio, don't go out there and buy a ton more. Because if the real estate market corrects dramatically, guess what? Your house is bringing a huge percentage of your portfolio value down with it. I don't consider a home obviously like an investment, like cash flowing vehicle, but it is an asset nonetheless, and it can reduce your cost of living. But you still got to look at it as part of your portfolio because, again, you just don't want to over concentrate into any given sector. And it seems like he's really into Canadian REITs. And the reason that I'm not, and I'm going to tell you this just in my personal opinion and experience, as somebody that he seems to make RioCan his largest position at 20,000 here. It's a huge chunk of his portfolio. And I, as somebody that made good money on RioCan, buying it in the pandemic, riding the rally out of the pandemic, and then just basically selling it off up here in that 20 range, did very well with it. And I know REITs right now are trading well below their NAV, but you got to ask yourself a serious question with Canadian REITs. Toronto real estate has gone through one of the biggest booms in global valued real estate history. I mean, I think 2010 to 2020, it basically doubled. I mean, we've seen it almost 2.5, 3x in the last 15, 20 years. Yet regardless of RioCan having the most valued properties and largest square footage of any Toronto publicly traded REIT, why has it underperformed and not done anything from an equity standpoint since 2005, virtually the 2000s? I mean, mid 2000s, this stock hasn't offered any equity growth. So somebody, again, I've had a lot of friends that work in real estate pointed out to me that like you really need to question how these REITs are being managed, because you would have been significantly better off taking all that money you would have put in these REITs and even just owning a property and not even renting it out. You would have seen significantly higher returns than what we've seen out of a lot of these real estate investment trusts. Now, don't get me wrong, he owns a lot that are much like that have done very well. And for income orientation, I don't think they're the worst thing to own. But again, if you look at something like ZRE that he owns, this would probably be a better exemplifier of something you could just buy as an end all be all solution instead of just buying a ton of REITs. But even this gives you a really good example of how there's been very nullified equity return out of the most of the Canadian real estate market. This thing since inception has done pretty well. 8% is not that bad, but you can tell most of that was coming out of the 2008 financial crisis when real estate really started to boom, because since 2013, all of your return has basically come from a dividend, right? And we always know dividend strategies are more mature companies. There's less growth usually behind this. But again, I'm not saying it's a terrible ETF by any metric. For the right person, it could work out. I personally like VNQ. I think there's going to be more upside to the US real estate market once they start cutting interest rates comparably to the Canadian markets, because they're just bigger. You're going to see more cash flow coming into play, hitting the bottom line, more diversity. Canadian REITs are very concentrated. There's far and few in between. And again, I think more than half of Canadian REITs have significantly been mismanaged. I do like some of the megas out there, like Cap REIT as an example, but again, I just couldn't see myself just leveraging into them like this. And the only reason I could presume he's doing it is because he just lives in Canada and maybe wants some Canadian real estate exposure. But as again, to each their own. So long as you're investing, at least you're part of the investing class. But for me, I would significantly simplify this down to maybe 2 or 3 ETFs, because there's just no way you're going to properly manage this many companies. And again, we're only just talking about his TFSA. If we more broadly look at his portfolio, which my understanding is 200K, we start seeing a vast diversity of stocks in here. I mean, everything from like the upper weightings, we saw Iron Mountain. He's got XIC in here, which is nice to be a bigger holding, but XIC doesn't need to be 4.9%. And VOO is only 6.3%. I mean, I would significantly weight those ETFs up to make them part of a core holding. But then we can see it gets a little bit more scattered as we go. We start getting Procter & Gamble, DGRO, another dividend ETF, XEI, ZQT. We've got Bitcoin in here. We've got more REITs, VRE. We got ZRE, HR again. McDonald's is in here. XLK, another ETF that's 1.4%. Microsoft. I mean, it's just very, very scattered and all over the place. Walmart's in here. Apple's in here. Johnson & Johnson is in here. You've got more Ethereum with some crypto, 3M. Like, I just don't know if he's picking these stocks based on the flavor of the week or what, but I would really consider, just again, my opinion, nobody has to do this, but I would just not try and replicate my own ETF, because like you don't need several different ETFs. You don't need dozens and dozens of stocks. Really, 3 ETFs could encompass everything that he has here, and then maybe just buy a bit of crypto for diversity. For growth, and call it a day, especially if he's reinvesting the dividends. This is just my opinion and how I would kind of view a portfolio like this. But I'd love to get you guys an example on this corruption. Yeah, I will say some of the Canadian REITs have gone through their fair share of absolutely insane levels of corruption. A Saturday Live. Yeah, I'm crushing it on a Saturday, my friend. I'm a little bit busy tomorrow, but I got more content coming out tomorrow. Why no talk about HUR ETF? It's uranium. It's so pro-Canadian and it's blasting. Let's just take a quick look here. Yeah, this is another interesting conversation to be had. I'm going to post a video on if I was 19 and starting over again and just how I would structure a portfolio. But like, I like seeing people that find direction in their lives with their portfolios, and especially sectors that they think can outperform, and, you know, maybe speculate from that aspect, like Brandon's trying to do. I think it's more appropriate to, again, structure a portfolio for cost averaging, and then again, cost average into the many, focus on the few. That's always the end game here, because I love running into people like yourself that are looking at sectors that are largely underappreciated, perhaps like the uranium space, and speculating on it a little bit more heavily to get some growth. This is not what you're talking about, clearly. What was the ETF that you just recommended there? HUR ETF, definitely not this one. HUR ETF. You're talking about a uranium ETF, this one here. Let's take a quick look. Year to date, it's up 55%, so it is absolutely crushing it. Let's just take a quick viewpoint of this. Dividend, yeah, surprisingly, even has a dividend yield here, but let's just take a look at the holdings and see. As I imagine, it's just upperweighting a lot of the uranium stocks. Since inception, it's annualized 29%. Just ridiculous. You're getting Cameco. Yeah, this would be a great play for the uranium space. Commodities are absolutely exploding right now, and I think it's probably one of the most underappreciated aspects of the market. I mean, obviously, everyone's focused on tech. I haven't touched gold, uranium. I haven't really touched a whole lot of any of these sectors personally, but I think, again, if it interests you and you're paying attention to it, I mean, yeah, go for it. Go balls to the wall, man. Try and make some money on it for sure. I've trimmed down to 5 positions, been expanding lately. When the crash comes, can't handle all 30 positions dumping at once. Impossible. Eyes on 1 or 2 at best. So you really want to buy things that are materially ride or die, which is why, like, I keep mitigating like my investments in Google or individual stocks, because, you know, like you're saying, when the market takes a major hit, this is when you're going to wake up to the reality of like, how much do I know about the investments that I hold? Because if you were just mainly holding REITs through the pandemic, especially Canadian REITs or REITs in general, you have been slaughtered from a rate of return. It's why it's prevalent not to focus on any one given sector, because people will think like these sectors are incredibly safe and this and that. But if you get too caught up into it and you go through one of these cyclical cycles where they just crash and underperform for 5 or 10 years, you get really hurt. And I think a lot of people, if we go through a cyclical correction in technology, will come to the same awakening as this, which is why, again, it's just so much easier to focus and core focus on either global market or an S&P ETF, because those will naturally weight their way in and out, right? Like they're market cap weighted. So yeah, you're going to go down with the market regardless, but you're going to go down in a way that is unemotionally going to allocate toward the stocks that outperform, which could be the lower half, you know, utility stocks. It could be energy stocks. It could be healthcare. Those will naturally work their way back up and cushion some of the blow when tech or NVIDIA start to underperform. And I think people forget that a lot with ETFs, because I know when the market tanked in 2022, I was sketched out because I owned a lot of individual stocks and I couldn't sit here and knowingly tell you what ones would come out on the other side of it successfully. So I would let the ETFs naturally figure that out for me. And then again, I just ride through it, always remaining in the market. Don't try and sideline with cash. Just always keep in it, because in these bull cycles, guys, people are really getting testy. I mean, even today, my dad's like, we should just sell everything and wait for the crash again. And I'm like, if you get into that mindset, I promise you, you're eventually going to lose substantial amounts of cash. 2020, I mean, the Terrafor is probably the best example, right? I heard so many people that stacked cash thought it was getting so much worse. It jumped up 10, 15% before you knew it. We were up 30%, right? I mean, you can't try and start playing that game with yourself. It's a formula for disaster. H1B News makes some Mag 7 stocks go down a bit, but who knows in this market? Yeah, I think the H1B was Trump increasing the price, I guess, for people coming over that are working here to try and get them to bolster U.S. employment. I know Trump is messing around a lot with the mega caps right now, but it's important to note that could change very quickly. I mean, obviously they're all going to bend the knee because they want to keep their businesses in the best faith of shareholders. So they're going to say yes to Trump on 5-10 year basis, sending in 100 billion, 600 billion, whatever Fugazi numbers, Meta or Mark Zuckerberg is going to throw out. But regardless, guys, if Trump is out of office, they could completely pivot that and immediately just cut off and maybe go somewhere else if they're going to get a different administration that's going to be more lenient on how they're operating globally. Who knows? He tacoed soon, levied. Yeah, I mean, it's nothing I focus on. I don't care about politics. I don't buy stocks based on politics. I know a lot of people like to think that can correlate, but it doesn't usually. I mean, think about it in Canada, right? Like, we're in a full-blown economic crisis. Unemployment's rising, steel, a lot of tariffs are detrimenting some of our major industries, yet somehow we're at all-time highs in the stock market. If you came to me a year ago and asked me where you thought the market was going to be, even coming out of the tariff war, where I thought the market was going to be, I wouldn't say it would be here. I don't think anybody would, right? Because stocks don't correlate necessarily to the underlying economy, especially when you're talking about upper weighted sectors like metals. Like, regardless, if central banks are gobbling up precious metals and it's one of the biggest sectors of our market, yeah, you might lose jobs in steel, but those jobs might be made up for in the precious metal sector, right? Who knows, right? Like, there could be some ebb and flow balancing between that. Same with the mega banks. Like, I hear people all the time right now saying, don't buy bank stocks, they're overvalued. But I just had a really good conversation with a buddy of mine saying, like, let's use Royal Bank as an example. And I always say, like, I'm not saying it's cheap. Obviously, I think a correction would be great. And if we use the dividend yield as an exemplifier, which is what I always try and do, because I just say, hey, typically these are better to buy when the dividend yields are at all-time highs. So if you look at the dividend yield, we're at literal decade lows. Like, you haven't seen yields this low on Royal Bank since like 2007. Like, this is a very low yield for a mega cap bank, but I think there's justification for it because I'm presuming if we go to Royal Bank, investor relation, and let's just take a look at the financial document real quick, because what I find really perplexing is if we're pricing in the growth of loan loss provisions deteriorating in the banks. So loan loss provisions, for those that aren't aware, basically our mega cap companies in Canada are the banks. And the banks recently have been going through a cyclical cycle of an interest raise period, which really put at risk the loans in the economy. Because basically the bank looks at the cash flow the company is producing that's taking the loan, or the individual that's buying a mortgage, and they say, hey, we're going to give you a mortgage rate of 1.5%, 2% in this current market. You're making this much money. Okay, we trust you, right? It's a AAA rated mortgage. You're making a couple $100,000 a year, whatever. But then all of a sudden interest rates jump up to 5 to 6%, and your renewal is coming up, and your rate's going to go from 2% to 5 or 6. Now the bank says, holy shit, we can't trust you as much because based on your previous cash flows, your mortgage renewal, oh man, this is getting sketchy, right? Like, you're getting pretty close to the income level, and that's a lot of your money going toward your mortgage. We don't trust you. So the Canadian government says you need to put money aside, the bank, even though we haven't defaulted, you still need to put that money aside because we're worried that the economy could get shaky and loans could start to default. So to protect us consumers, the bank by law puts some money aside. Now we're in the other half of the interest rate cycle where interest rate cuts are happening, and that risk ratio on loans that are out there are starting to alleviate. So, I mean, from the last quarter, loan losses were sitting at 1.4 billion. And for the quarter just posted, we were at 881 million, which significantly bolstered the bottom line because this gets taken out of the earnings. So loan losses, we don't get to see that as shareholders. So if you look at the earnings per share, guys, $3.76 versus $3.09 this time last year, and $3.03 just this time last quarter. So I'm under the assumption that if this perplexing period of Canadian economics continues, again, these banks, even on the back of lower immigration, have been making record revenue quarter over quarter from 15.6 billion to 16.9. Like, the growth rate of this bank on an annual basis is insane. It's astonishing for how crazy the news is in the economy. It doesn't make any sense. But you can't argue the fact that it deserves a higher valuation today if this growth is going to continue for another year or two. It really starts to justify the 15 times multiple, right? So I don't know why this is happening other than the loan loss provision. So we'll see as time goes on if I'm proven right. If I'm wrong, then the banks might correct a bit. We'll find out very soon, regardless. But you can't tell me that just, based on these mega cap earnings and these Canadian companies that we're not doing good. Like, we're definitely in a weird time. And I know people kept saying like, oh, this time it's different. You keep saying that. And I'm saying from a cash flow perspective, it's different. It's not like the dot-com bubble, guys. Like, forward valuations on companies are significantly lower for projections than where they were during the dot-com era. And I've talked about this in quite a few videos, right? If you pull up like the forward PE on the S&P 500, you can see there's some variant difference here, right? So the next year forward PE expectation is going to be what? Like a 23. And yeah, it's high. It's not low, but it's nowhere near the peaks of like 32 or whatever during the pandemic or the dot-com bubble, right? Or this is 2008. Geez, that's 2008. This doesn't even go back to the dot-com bubble, but I promise you the price to earnings multiples were significantly higher on a forward basis in the dot-com bubble. And even since 2008, I mean, that was a horrific time, but still, like, I mean, we're not living in cheap times, but we're still in a good growth era. And there's going to be probably another 20% correction sometime down the road. God knows it's going to happen. We're going to get another correction, guys. I promise you it's coming, but you can't bank on that. It's stupid to try and think you can. Any worries about the home prices dropping? Many on my street underwater by 1 to 200K. So major debate. Talked about this a lot too. And same with the REITs. I'm speculating that we're starting to see a bottom in Canadian real estate prices because yes, we have seen up to 20% corrections, 30% corrections in certain sectors of the real estate market, especially in major metropolitan areas when it comes to detached homes that are worth over 2 million, condos that are little boxes. But in other markets, we're starting to see it pick up again. So we've seen year-over-year growth in everything from Alberta, Saskatchewan, Manitoba, Quebec. Out of the major metropolitan areas where real estate's more affordable for the average person, it has gone up in value. So I'm telling you, I think this is a buyer's market. I think when this opportunity goes away, people are going to hate themselves saying, oh, I had an opportunity to buy, I didn't. Interest rates are coming down. It's making it easier and giving people more access to capital. So I'm just telling you, if you're interested in getting into real estate, the last 10 years, guys, was nothing but up and to the right. Bidding wars across the board. It was a horrible market for people entering. But guess what? This is why we bought a piece of real estate, because I'm very good at buying when everyone's telling me not to buy, and it's always worked out. So we'll see what time brings. It's just really depends on where you're at in your life. My Vancouver home down about 10 to 12%. Demand and price probably rises, rates are cut. Yeah, again, if you bought in the last few years, you've probably seen a cyclical downturn, but I promise you, if you bought it with the intention of being in it long-term, come back to me in 20, 30 years and tell me you regretted it. I don't know anybody that's owned a home over 30 years that regretted it. I mean, it significantly should lower your cost of living over time. I mean, I always, like, I'm like Dave Ramsey. So long as the formula makes sense and you're going to live somewhere for over 10, 20 years, you're usually better off buying, so long as the math makes sense. It always comes down to the math. Remember in 2021, 2022, real estate agents used to come to the door and say, oh, sold a house in the neighborhood, would be interested to sell yours. Yeah, now's a good time to hustle. I imagine a lot of real estate agents have dropped off the board. I mean, there can't be a lot of guys still floating around like there was. Everyone and their grandmother was a realtor. Now they probably, shifted into some other careers as things have dried up a bit. But yeah, I'm 6% cash, lowest cash level I ever had. So for me, I'm usually around 5% cash at any given time, give or take. Actually, yeah, 5%. I mean, between all of our accounts, I usually just keep building them up for like our mortgage account that will pay off. Like we just had a huge amount of cash that we put toward the mortgage again to pay our 15% annual to fast track the mortgage. But yeah, I'm not much more than a 5%er. I don't like leaving a lot of cash around personally, just enough in case the markets tank or I need to get a new car, anything like that. Personally, USD ETFs, I think is pretty good. I'm mostly US. With rate cuts, yields would it reduce? Yeah. Anyways, guys, my Saskatchewan home has increased 200K in 5 years. Look at the general real estate market, man. Let's just pull it up real quick. Real estate, Canada. Value. Yeah, this is one of my favorite things to look at here. This is a great website, by the way. If you ever take your time and you want to look at real estate, Wawa, great real estate website. It gives you a lot of data. But yeah, so you're saying you're based out of Saskatchewan, right? So you've probably seen quite a substantial increase. I mean, they're up 7.9% just year over year. Again, cyclically month over month, they're down, but seasonally, they adjust month over month. But just look at the annual. Man, if you bought a house last year, it's 8%, Alberta, 1.9%, depending on whether you're in Calgary. Calgary, I believe, has seen a significant jump in real estate prices because everyone's leaving Ontario and moving out that way, right? But regardless, I kind of wanted to round the conversation off here, guys. I know it's a bit of a quicker stream, but I don't want to get too off gear. And I just want to rope back to the initial conversation here. Do you guys have your portfolio on Blossom? I'd love to review it. You could always leave it down in the comment section with your name if you want me to go check it out, and we could have a real live debate about it. I've been more or less getting into this idea of just reviewing these portfolios because of how interesting that last review was, getting called out by the passive income investing guy. But I thought it'd be fun to just take a quick broad view of the markets here on a Saturday night and get your guys' opinion. So I will pass the question off to you at this point. I'd love to know what you think about these portfolios in that comment section below, how you're managing this market cycle, and hopefully you're staying on course. Always be buying, baby. But on that note, I think I am going to kick off and enjoy the rest of my evening. Just a quick stream. Stay cool, stay awesome. And as always, I look forward to catching you in the next one. Peace.